Hey, welcome back, everybody, to the Real Money Pros podcast. I'm your host, Nick Daniels, and today we're going to talk about how to invest $1,000 right now. If you had $1,000 to invest today, how should you do it? I'm going to tell you. But before we get into that, I've got to say, keep going to our website, therealmoneypros.com. Every time you click the Ask the Experts feature, it sends myself and our whole team of experts, whether that's real estate, insurance, health insurance, life insurance. Anytime you click that button, it sends all of us an email and we can get your financial questions answered as fast as we possibly can. So let's dive into what we're going to talk about today. If you're a young 20-year-old person and you're like, I'm ready to start investing for retirement, I've got $1,000 burning a hole in my pocket. Nick, how do I put this to work? We're going to talk about that today. So first of all, let's go to the whiteboard and I'm going to show you things that really you should be focusing on when it comes to how to invest $1,000 today. All right, so here we are back at the whiteboard. Let's take a look at how 25-year-old Nick can invest $1,000 right now. And here's what it is with the caveat, I'm investing for retirement. So what I'm going to do if I'm 25-year-old Nick Daniels with $1,000 to invest, I'm going to look at 4 areas. U.S. large cap, U.S. mid cap, large cap meaning largest capital, mid cap meaning mid capital, U.S. small cap, and sure, let's mix in some international. So if I'm investing $1,000 for retirement, I know that this has 40 years to stew. I'm 25, I'm not retiring until I'm 45, right, or 65, that 40-year time span. U.S. large cap, me, I'm going to go 40% into that. I really want that large cap growth. Mid cap and small cap, I'm going to do 25% each into these ones. International, I'll dump 10% in there. Now again, the idea, the goal is that I'm picking funds within these categories that have a 10% return or better. I don't want you to get confused. Over a really long track record, a really long time frame. So if I can find funds here that have hit 10% or better for 20 years, 15 years, 25 years, it's got my eyes. Why? Because if I'm investing for the next 40 years and this fund has consistently hit a 10% return or better for 20 years, odds are highly likely that the people managing that fund are going to be able to continue that trend. It's not a guarantee, but the trend can be your friend. So this is a goal, a 10% return over a really long period of time. International, it is kind of hard to do. I'm not going to lie. All right. So here is the actual numbers, though. You got $1,000. That means $400 should go into a large cap growth fund. It means $250 should go into a U.S. mid cap growth fund, index fund, because they're very affordable. Another $250 going into this U.S. small cap, and we're dumping $100 into this international fund. That's how my initial $1,000 is going to get distributed into the market. And then if I'm doing $100 a month, it's pretty easy. $40 a month is going into that same fund for U.S. large cap. $25 a month is going into my mid cap fund. $25 a month is going into my U.S. small cap fund, and $10 a month is going into my international developed fund. That's what 25-year-old Nick Daniels should be doing with $1,000 initial investment right now and $100 a month in ongoing contributions. This right here could easily get him across the retirement finish line a millionaire. We want to take a look at staying within the U.S. market. If you just look at the history of the markets, whether you're looking over in Hong Kong, the rest of Asia, Europe, wherever, it doesn't matter. The U.S. market has always been the most robust, okay? And so if I'm investing $1,000 today and I'm in my early 20s and I know I'm investing for retirement, I'm going to be looking at the U.S. market. I'm going to be looking at U.S. large cap stocks. I'm going to be looking at U.S. mid cap stocks, U.S. small cap stocks. And you know what? I do want a little bit of international spread in there. But here's the thing. That's why we're looking at U.S. large cap, U.S. mid cap, and U.S. small cap. And what does that mean? Large cap, Large capital, huge corporations, Meta, Microsoft, Apple, Tesla, you got it. Mid cap, medium-sized companies. Small cap, smaller-sized companies. And then, of course, international. So there you go. We're looking at those categories. Now, a great rule of thumb, and I'm not the only person that's ever said this, and I'm not the only person that will ever say this, but a really great rule of thumb is you want to be in the growth categories of all of these companies, or all of these categories, I should say. Your large cap, mid cap, and small cap, growth. You don't necessarily need to worry about value. If you want to go value, you can. But basically, let's stay focused on growth, because if I'm in my 20s and I'm investing for retirement, I got a 40-year time horizon. I want to be aggressive. I want to go after growth. And so here's what I want to do. I'm going to put 40% into U.S. large cap growth. I'm going to go 25% into U.S. mid cap. I'm going to go 25% into U.S. small cap. I'm going to go 10% in international developed. So that's going to give me exposure to all over the world, the developed companies within those nations, and boom, there we go. A simple ratio, 40%, 25%, 25%, and 10%. And I know what you're going to say. You're probably thinking, well, Nick, why would I do this? And what should I be, what should my targets be when I'm looking at this? Well, to answer that question, let's check out the phone. I'm going to pull up a very simple compound interest calculator that I have on my phone. Now, as you can see, $1,000 initial amount right there, that's $1,000. You got $1,000 burning a hole in your pocket. You want to get invested today. There you go, initial amount. Now, this annual return, this is a very important function that we're going to use. Let's just start off and say, hey, you get really mediocre returns. And we're going to say for mediocre, let's say that's 6.5% per year. Duration, obviously 40 years. If I'm 25 and I'm not going to retire till I'm 65, that's 40 years. Because that's the generation I grew up in. Most people retire between 60 and 65 in my generation. So here we go, 40 years, that's the duration. Now, if I don't add another penny to this, wow, look at that. My $1,000 investment over the next 40 years has turned into $12,416. That's nothing to write home about. But what if I dump that $1,000 in right now, get it to work, it's making 6.5% return, but you know what? I want to add $100 a month, which is the same as $1,200 a year. Well, check it out. Over the next 40 years, this account could be worth $223,000. And I know what you're saying. That doesn't really move the needle. It doesn't get me excited at all, Nick. And you know what? I couldn't argue with you. That doesn't get me all that excited as well. That's why we've got to look at this annual rate of return. There's a lot of people out there that would agree that the S&P 500, that index, has averaged right around a 10% return pretty much forever. Some years it's a little bit higher, some years a little bit lower, but if you take a 10-year chunk of time and look at the average, it's a generally accepted rate of return of 10%. So if I change my annual rate of return to 10%, and I start off with $1,000, and over the next 40 years, I continue dumping in $100 a month, compounding and contributing annually. Now I've got over $500,000 at a 10% return. What if you got a 12% return? Check that out. Now I'm looking at an account with over $1 million in it. That's really doable. Are you going to hit 12% return every year? No, probably not. But you could. You could. So you can see how the power of compound interest over time is really going to help you reach those long-term goals. What I love looking at this here is the contribution. You've put in $49,000 of your own money over the course of 40 years, and that $49,000 investment has grown $964,000. That's remarkable. Can you really find funds that average a 10% return over a long period of time? And the answer to that is yes. So as I was prepping for this podcast, I just thought, well, let's go to Invesco's website. So here we are at Invesco's website. I pulled up all their exchange-traded funds. Pretty easy to do. Click on products, click on exchange-traded funds. All right, now, we're investing for retirement. I'm 25-year-old Nick Daniels. I plan on working another 40 years. So here's what I want to do is under exchange-traded funds, I want to filter this. Let's just look at equities. Equities is the same thing as stocks, right? I want to invest in companies that are growing. Here we go, U.S. equity. Now, let's take a look at this RSP. All right, here we are. I got it highlighted in gray. RSP, it's the Invesco S&P 500 Equal Weight Exchange Traded Fund. Let me point out a couple reasons why I like this fund. First of all, It began in April of 2003. So this thing has almost a 20-year track record. The other reason I like this fund, let's look at the expense ratio. 0.2%. That's very, very affordable. That's way cheaper than most mutual funds out there. That's a really good price for an exchange-traded fund, so I like it. And now, when I know that this fund's been around since 2003, and I look at since inception, this fund has averaged 10.8% per year. Go back to that compound interest calculator, type in 10.8%, and see what kind of returns you get. Now we're starting to talk about having an account that could be valued at over $1 million when you're ready to retire. So this is a great fund. This is the S&P 500. This is going to be your large cap U.S. fund. There you go. We just picked one. Now, let's compare that for a second. This equal weight, I really like the equal weight because it means that you're not getting out of proportion. You know, you don't have more Meta than you have some other fund just because Meta has really, really grown in one particular year. I like this equal weight fund. Let's compare that to QQQ, which is essentially the same fund but not equally weighted. It's been around a little bit longer, since 1999, so about 4 years longer. Obviously, this fund went through the dot-com bubble of 2000, 2001, plus the terrorist attacks in September of 2001. So it's down a little bit, 8.1%. So I like the equal weight of that RSP fund. And there you go. You've just found a large cap U.S. growth fund that you could invest in. How about mid cap? Let's look at the fund. Here we go. XMMO, this Invesco S&P Mid Cap Momentum Fund. Again, it's been around since 2005, so almost 20 years. Again, a pretty inexpensive fund at 0.33% for its expense ratio. We take a look at its average since inception, above 10%. For me, it's pretty simple, but there you go. That's a great fund to take a look at. You could also look at this one just above it, this EWMC. This is the Invesco S&P Midcap 400 equal weight. But again, this fund here hasn't been around quite as long, since 2010. That's why I like this XMMO. And this one, it's a longer track record of having positive gains. So that would be an example of a great mid-cap fund that you could take. All right, let's go to small cap. How about DWAS? Let's scroll down. So here we are. You see highlighted in gray, DWAS. It's the Invesco DWA Small Cap Momentum. Again, this is a great growth fund in small cap. Again, here's why I like it. It's been around since 2012. So again, I'm trying to find a long track record here. This fund, about 10 years, but what has it averaged over the last 10 years? 11.97%. Again, if you can find the longer the track record, the better, in my opinion, but this is one that would qualify as a great small cap growth fund as far as representing 25% of your investment amount. Am I saying this one's right for you? I don't know you individually. I'm just saying if I was 25-year-old Nick Daniels, this is one that I would be considering for long-term growth. I know what you're thinking. What about oil? What about tech? What about those sectors? Well, it can be enticing to do that. Well, let's just go to this section here at Invesco's website. Again, I'm saying the same thing, but let's look at sector equities. Here's one that's really, really interesting. Sector equities. And we can look at this energy exploration and production exchange traded fund. It's been around since 2005, so it's got a long track record. Its expense ratio is 0.63%. It's under 1%. That's acceptable. And I bet you're thinking, oh man, energy, oil, over the last, couple decades, probably been a great returner. Well, in this year, 2022, yeah, it's up almost 77%. Killer. But what's its long-term track record? Look at this, 6.4%. You want to mix a little bit of that in? I wouldn't be against it. You want to feel like you're doing something more strategic than just indexed funds? Sure, go for it. But overall, since inception, it hasn't produced as well as those first three funds that we took a look at. There you go. Now you have it. You've got how to invest $1,000 today if you're 25 years old, and how to keep investing $100 a month over the next 40 years to get you into retirement as a potential millionaire. All right, you guys, thanks so much for listening and watching. I'll catch you again next time.